Bleeding Edge subscribers, welcome back to the newsletter. On today's video, we're going to jump into the question and answer mailbag and answer a couple of questions that have come in. You can always contact me with your questions and we might answer them here on the newsletter. Let's not waste any time, jump right into the first one. It says, can you explain why you don't believe that submerging servers in a liquid is not a good application for large data centers? Now, this dates back to a newsletter we sent out, I believe it was last week, where we talked about how Microsoft has this Goodyear, Arizona AI data center, and it was reported in the Atlantic, just in this single data center alone, in order to keep the facility cool enough to be operational and running at peak capacity, Microsoft burns through nearly 60 million gallons of water a year. And again, in just one single facility. And Microsoft operates dozens, if not hundreds of data centers around the world. One method that is an alternative to using water and traditional air conditioner to keep the inside of a data center cold is actually submerging the entire server in a liquid bath, if you will. Now, obviously, that's a really tremendous way to keep something cool, and it actually works extremely well in a server environment. Now, I had to clarify, and I wanted to make sure I give you the best advice possible. So I have a buddy that works at one of the three largest cloud service providers. He did not want me to say which company it was, but it is one of the three largest: Microsoft, Google, or Amazon. He just doesn't want it to come across as an official company statement, if you will. I talked to him about this, and he said it would be difficult for his company to convert its existing data centers to a submersive liquid environment. So the architecture has to change. Obviously, they have to bring in large amounts of water and liquid that could create an environment in the existing data centers that might be difficult for these companies to be able to adapt to. What he said would be easier is for some of this on-device technology that essentially puts air conditioning much closer to where the heat source is, which is these large AI chips, instead of having these fans and water vapor across an entire room. He says it'd be far easier to retrofit the existing large data centers in that fashion. Now, what he did say is newer data centers that are currently being constructed, certainly smaller data centers as well, could use this submersive liquid. So they both are a great alternative, but in terms of the existing data centers, it would actually be a little bit easier from an architecture perspective to use some of the AC and thermal devices that are out there on the market. As I noted, Exponential Tech subscribers, we identified this trend last year through all the research that we were doing. We realized this was going to be probably a major trend, and one of the stocks that we recommended in this space, one of the market leaders, if you will, at least from a small cap perspective, we recommended those shares last year, and Wall Street has taken notice. Shares of that company are up, I believe, about 90%. So this is something going forward that we're going to continue to monitor. It'll probably be maybe a fluid situation, if you will, in terms of the technology that is used. And it is something that I am looking at every single day, trying to read and research as much as possible. And when I find out any new information, certainly bring it to you here on the newsletter. Now, the next question that we got was David Einhorn, hedge fund manager, if you will, big Wall Street titan. He says passive investing in AI and algo trading is fracturing the markets, and active stock picking is shrinking. And I certainly agree with that. I think all the stats back this up. And I think there's a couple of reasons for it. First of all, you have a lot of people that correctly realize that growing your wealth in the stock market is fantastic. But the vast majority of people out there, they just simply can't do anything other than passive investing, okay? Because they have a 9-to-5 job. They come home and they're tired. They probably have a family and a kids. And if you're like me, you're picking up the kids. You've got to make dinner. And maybe at the end of the day, you might have an hour to yourself where you can watch a TV show or a movie. Or if you're like me, you're totally geeked out in these stock markets. You're waking up, looking at the stock charts. You're doing it. I mean, it's essentially my job. This is what I do every single day. But most people don't fall into my category. So they have a 401k, an IRA, And money is just passively being dumped into that. Now, what we've seen in the stock market is that has created a concentration, if you will, around really the largest companies, the Apples, the Microsofts, the Googles, and the Amazons. They have seen a huge inflow from these passive investing funds because let's face it, you look at the financials of these companies and the fundamentals of these companies, they're producing some of the highest amount of cash flow, the highest amount of free cash flow, the highest amount of profits and revenues. And those are obviously great things for shareholders. Now, what I think David Einhorn may be correctly identifying is this is fracturing the markets, as a lot of people are getting their exposure through passive investing. But what I think this does is this creates a great opportunity for active stock pickers to actually prove that they are worth it. Because you have passive investing options where you can just dump your money into a fund and let the fund managers at Fidelity or Schwab do all the work after that. You also have AI and algorithmic computer trading, often being run by the largest hedge funds, often being sold as an option to investors as well. Active stock pickers have to do a better job at proving and providing value to our clients. And I think we do that here at Brownstone Research. If you look at the near future report, out of all of the stock selections that we have recommended since I took over nearly a year ago, one is hovering around unchanged and the rest are higher, 40, 50% gains in some cases. You have to prove yourself time and time again if you're an active stock picker. It's not an easy thing, as I know firsthand, but every single day I wake up wanting to prove and get better at it. And while I think passive investing and algo trading certainly has its place in the stock market, active stock picking, active research, fundamental, boots on the ground, if you will, research will always have its place in the stock market. And I think if you find somebody that is actually good at it, it's certainly worth paying for. Now, the last question that we have, this is a great question. So this one is, will people pull money out of stocks and pour it into crypto? And what impact will that have? Now, obviously, as I speak to you right now, Bitcoin and cryptocurrency in general is absolutely on fire. I think Bitcoin even today hit a fresh all-time high. Now, certainly we've seen probably some people pull their money out of stocks, pour it into crypto, but there's going to be some reverse effects to this as well. I, as somebody that certainly appreciates crypto but has more of my assets invested in the stock market, I never worry if people are avoiding stocks, because when I am buying a stock, what am I buying? I'm buying the future cash flows of that business. I'm buying the future profits of that business. If people don't want to invest in that, if people don't want to appreciate that, chances are I'm actually going to get those profits and that free cash flow at a better price. And then what is that company going to do? They're going to take that cash flow, they're going to reinvest it into the business and create a larger business. The other thing that they might do is they might buy back the shares. So my equity stake is increasing by the profits of the company buying back the shares. The other thing that they can do, and we've seen this actually recently with two tech companies, Meta and Salesforce.com, just over the past 2 months, announced new dividends over that company. I would have never guessed at the start of the year, Salesforce in particular, but including Meta as well, would actually introduce a quarterly dividend. So they're taking their profits and they're going to give you a share of that every 3 months in the form of a dividend. Another thing companies can do with excess free cash flow is they can go out and acquire other companies and create a larger business in that sense. You look at a company like Broadcom, they're constantly doing this, particularly in the software space. So if crypto's the flavor of the week, if you will, or if it's a long-term thing and it is a long-term catalyst in order to pull money out of the equity markets and into the cryptocurrency markets, I really don't mind, because that means the shares of the companies that I want to purchase and that I want to be a part of might come at a lower cost. Folks, that was the bleeding edge question and answer mailbag issue for today. Down below, there's an email address if you want to get a hold of me. Love to hear your comments. I read them all, and any questions I'll try to bring here for a future video. Thanks for tuning in. Have a safe weekend. I'll see you again next week.